Hi, welcome to Chapter 6, Interest Rates and Bond Valuation. So in this chapter, we're going to talk about the interest rate fundamentals, the term structure of interest rates, risk premiums. We're going to look at the legal aspects of bonds. We're going to look at bond features. We're going to talk about basic key inputs for the valuation process of bonds, and we're going to look at different basic valuation models for bonds. So we're going to explain yield to maturity, how it's calculated. We're going to talk about First, we're going to talk about interest rates and required returns. So an interest rate is usually applied to debt such as bank loans or bonds, and it's compensation for the borrower who lends money to a business to be compensated for the risks associated with lending that money. Now, required return is usually applied to stock, but it's basically the funds obtained by selling and it's the funds obtained in compensation for the risks of investing in some sort of investment or stock. So let's look at the factors that can influence the interest rate. So inflation is something that definitely can influence the interest rate. Risk will influence the interest rate, and liquidity preference. Okay, so inflation is really how much money is going to be destroyed by time. Risk is the chance that you won't be paid back. And liquidity preference is how quickly you desire your money to be able to turn it into cash. So for example, a savings account, you can turn your money into cash very quickly. However, a real estate investment may take longer. So liquidity is about how the cash conversion from the asset into cash. Now, let's look at how fear can turn Treasury bills negative. So in the height of the financial crisis in 2008, interest rates in the Treasury bill were turned briefly negative, meaning that investors paid more to the Treasury than the Treasury promised to pay back in interest. So why would anybody invest their money knowing they're going to lose money? Well, 2008 was so crazy that even if you had to lose a little bit of money, you still wanted your money somewhere safe. So investors were willing to pay U.S. Treasury to keep their money safe for a short term. And thus, we had our first negative rates on the T-bill. Now, we talk about the real rate of interest. This is the rate that creates equilibrium between the supply of savings and the demand for invested funds. So if this is out of balance, if we don't have the right supply or demand, then interest rates are going to fluctuate until it becomes equal or in balance. Now, so the real rate of interest changes with economic conditions, tastes, preferences, and supply-demand relationship that determines the real rate. I'll show in figure 6.1. But basically, the concept here is if there is too much savings, the there's too much money to be invested, interest rates will go down. If there's too little money to able to fund the demand for borrowing, interest rates will go up. And that's one of the reasons the Fed will create excess if they want to manipulate interest rates. Besides setting the federal funds rate, they can also affect the supply and demand balance by providing liquidity or money into the markets to try to manipulate interest rates like they did with their quantitative easing. Okay, so if we look at this, the real rate of interest changes with the changing economic conditions and tastes and preferences, as we know. So to combat a recession, the Fed Board of Governors might initiate actions to increase the supply of credit in the economy, causing the supply function to shift. So let's say S1 here, the lower cost of money. So when S1 meets at D here, that's what we're talking about, is equilibrium. And this is going to result in a lower rate of interest. So we have, the interest rate here. Now, if more supply is generated, say that the Fed artificially creates more supply, then the interest rates will lower, as we see at this point where S meets D on S1. So with the lower cost of money, firms may find that investments that were previously unattractive and are now worth undertaking. And as the firms hire more workers and spend more money on plant and equipment, the economy begins to recover again. So what is the nominal rate of interest? this is the actual rate of interest charged by the suppliers of funds and paid by demanders. So although interest rates and required rates of return are nominal, unless otherwise stated, the nominal rate of interest differs from the real rate of interest as a result of two factors, inflation and risk. When people save money and invest, they are sacrificing consumption today in return for higher future compensation. So when investors expect inflation to occur, they believe that the price of the consuming goods and services will be higher in the future than present. Therefore, they will be reluctant to sacrifice today's consumption unless the return can be earned on the money they save will be higher or high enough to allow them to purchase the goods and services they desire at a higher future price. So that is, investors will demand a higher nominal rate of return if they expect inflation. Now, so inflation expectations, we want to note them as IP, and issuer and issue characteristics as default risks and contract provisions are reflected as risk premium or RP. So if we want to calculate say if we add together the risk-free rate to the risk premium, we will get what we call the actual rate of interest, or the nominal rate, by this equation. So the two basic components are the risk-free rate and the risk premium, and that is what we would call the nominal rate of interest. Yes, okay, so for a moment, ignore the risk premium and focus exclusively on the risk-free rate. So the risk-free rate can be represented by this equation here. So the risk-free rate embodies the real rate of return plus the expected inflation premium. So this is the real rate plus any expected inflation will be our risk-free rate. So the risk-free rate means we're protected from the inflation that's expected, and we're also receiving our real rate of return. So inflation premium is driven by investors' expectations about where they think inflation is going to go, and if they think inflation is higher, then the inflation premium will be higher. And the nominal rate of interest will also be higher. Okay, so let's look at I-bonds adjusting for inflation. So one of the disadvantages of a bond is that it usually refers to a fixed interest rate. So once a bond is issued, the interest rates typically cannot be adjusted as expected inflation changes. So this presents a real risk to bond investors because inflation rates do change. While the nominal rate on the bond remains fixed, so the real rate of return actually falls. The U.S. Treasury now offers the I-bond, which is an inflation-adjusted savings bond. As a Series 1 bond earns interest through the application of a composite rate. So the composite rate consists of a fixed rate that remains the same for the life of the bond and an adjustable rate that is actually an actual rate of inflation. So the adjustable rate changes twice per year based on the movements of the consumer price index, and this allows investors to be protected from inflation, thereby creating a bond that is closer to being risk-free. So let's look at the impact of inflation. So here we see, we look at Treasury bills through time, through 1960s to 2012, and we see that the Treasury bills do somewhat mimic the inflation rate. So if inflation changes, so does the return or the rate on Treasury bills, because inflation is built into the rate, as we saw previously, what we're talking about here, where inflation premium is built into the nominal rate, and we see that expressed in this chart here. So what about the term structure of interest rates? So the term structure of interest rates is a relationship between the maturity and the rate of return for bonds at similar risk levels. So the graphic, when we display a yield curve, we're displaying the term structure of interest rates. So the yield to maturity is the compound annual rate of return earned on a debt security purchased at any given point of time and held to maturity. So basically it's the rate of return that you're going to earn the day you buy that bond, because it fluctuates because bond prices fluctuate, so the yield to maturity fluctuates. Okay, so here are three different yield curves that we can look at. We have a downward sloping yield curve, a flat yield curve, and an upward sloping yield curve. So upward sloping yield curve is what we like to see and what we expect. Now, so I guess we'd say this would be the normal. We have normal, inverted, and flat. So this would be the normal, inverted, and flat. So the normal yield curve is the upward sloping yield curve that indicates long-term rates are generally higher than short-term interest rates. The inverted yield curve is the downward sloping yield curve that it indicates the short-term rates are higher than long-term rates. That only happens due to Fed action of raising interest rates. And a flat curve indicates there's no change in the interest rate maturities between the maturities. There's a flat curve. So maturities that are due within 5 years have the same rate of interest as maturities that are due in 30 years. And the idea is if you have to wait 30 years to get your money, you should be compensated at a higher interest rate than if you're only waiting less than 5 years. So that's why this is normal. So in 2012, bonds did hit record lows due to the change in the economy. So this was really good news for the housing market because it allowed 30-year mortgages rates to go very low, which stimulated the housing market, which had just suffered a huge devaluation as the bubble in housing decreased. Now, this also allowed a lot of people who own homes to refinance their mortgages at lower rates, and this type of activity helps to stimulate the economy. So let's look at three theories of the term structure. So how does this term structure happen? So we have three theories: expectation, liquidity, and market segmentation. So the expectations theory, this is the theory that the yield curves reflect investors' expectations about future interest rates. So the expectations of higher interest rates result in the upward sloping yield curve, and the expectations of declining rates in a downward sloping yield curve. So if investors expect inflation and expect more inflation in the future, we'll see that longer term rates are higher than shorter term rates, and that would be the expectation is expressed in the yield curve. Now, so suppose a 5-year Treasury note currently offers 3% annual return. Investors believe that the interest rates are going to decline. And 5 years from now, they expect the rate on the 5-year Treasury to be 2.5. So according to this expectations theory, what is the return that a 10-year Treasury note has to offer today? What does this imply for the slope of the yield curve? So basically, consider the investor who purchases a 5-year note today and plans to reinvest in another 5-year note in the future. So over the 10-year investment horizon, the investor expects to earn about 27%, ignoring compounding. That is 3% per year for the first 5 years and 2.5% per year for the next 5 years. To compete with that return, the 10-year bond today should offer 2.75 per year. That is, the bond that pays 2.75% each year for the next 10 years produces the same 27.5% total return as the two 5-year series bonds. So the rate today is 3%, and the 10 years 2.75%. The yield curve is downward sloping. Liquidity preference theory suggests that long-term rates are generally higher because higher than midterm or short-term rates because they're better liquidity. So investors perceive short-term investments to be more liquid and less risky, therefore they'll have lower interest rates. And that's, so borrowers must offer higher rates for longer term to compensate investors for this preference for liquidity. And that's another theory. Market segmentation theory says that the loan segments of the market and the basis of the maturity of supply and demand within each loan segment. So short-term, mid-term, and long-term loan segments have nothing to do with each other. They have their own separate supply and demand mix, and that's what is going to create the prevailing rates in each market segment in the yield curve. Okay, so risk premiums, issue and issuer characteristics. So far, we considered only the U.S. Treasuries when looking at the yield curves and talking about inflation. So the nominal rate of interest for security is equal to the risk-free rate consisting, as we talked about before, the real rate of interest plus the inflation expectation premium plus the risk premium. So the risk premium varies with specific users and specific characteristics. So the risk premium for government treasuries are all very similar because they're all used government treasuries. But when you're talking about risk premiums for different corporations, they're going to be significantly different based on the risks of those different corporations. Okay. So if we look at, here are the U.S. Treasuries, the nominal interest rate, the corporate bonds, high quality, medium, and low quality, and you see that these interest rates are all, the nominal interest rates are all very different. And if we look at the bond ratings, we'll see that the risk premiums on different bond ratings are all different as well. So let's look at 3 debt-specific risk premium components. One is default risk. So this is a risk that the company we're investing in is going to default and go bankrupt. A pretty big risk. Maturity risk. The longer the maturity, the more value a security will change in response to given changes in interest rates. So the longer term the maturity is, the more risk is that interest rates will affect, changes in interest rates will affect the value of my bond. And the contractual provisions risk. This is, bonds can come with specific risk, specific contractual obligations and agreements on the issuance. So that could be something that, for example, a provision allowing a bond issuer to retire its bonds prior to their maturity under favorable terms is a risk that you're not going to receive all the interest that you expected, and the bond's life will end early. So these are 3 risks, components of risk for bonds. So now if we talk more specifically about corporate bonds, here we're talking about, again, long-term debt instrument that a corporation uses to borrow money and it promises to repay to investors at a later date. The coupon interest rate is a percentage of the bond's par value that will be paid annually in 2 semi-annual payments as interest. We call it a coupon interest rate because long ago bond investors were given this coupon book that signified the payments of the dividend, and they would rip out their coupon and bring that coupon to the brokerage or bank and get their dividend. And even though that is long gone, we still call it coupon rate or coupon interest rate. So the bond's par value or face value is the amount borrowed by the company in the day the bond is issued, and this amount owed to the bondholder on maturity. So the bond's par value is both is generally thought of as a future value, because this is the money you're going to get in the future. So you could buy the bond for more or less than its par value once it's trading, but the par value is what you're going to receive in the future. So a lot of times par value is considered to be the future value in our bond calculations. And the bond's maturity date is the time at which the bond becomes due, and the principal or the par value must be repaid to the investors. Now, a bond indenture is a legal document that specifies both the rights of the bondholder and the duties of the issuing corporation. So a legal document. And the standard debt provisions are provisions in a bond indenture that specifies certain record keeping and legal business practices that the bond issuer must follow. So normally they do not place a burden on a financially sound business, and it's just to make sure that everybody's on the same page. And restrictive covenants are provisions in the bond that place operating financial constraints on the borrower. So they may say things like you can't issue a dividend greater than this amount, or you can't sell your inventory or accounts receivable to an outside party. So just things that would restrict you from certain business activities. The most common restrictive covenants are as follows. Requirement for minimum level liquidity, assure against loan default, prohibit the sale of accounts receivables to generate cash, imposed a fixed asset restrictions, so the borrower must maintain a specific level of fixed assets that guarantee the ability to repay the bonds. Meaning that so if they have real estate or maybe different machinery assets, they can't sell them and lease them back because then that lowers the collateral value of the company. Constrain subsequent borrowing, meaning that there's only so much additional borrowing they could do, which prevents your company from becoming too overly leveraged, and limit the annual cash dividend payment. Now, The other aspects of corporate bonds, it can have a sinking fund requirement. These are restrictive provisions often included in the bond indenture, providing a systematic retirement of a bond prior to their maturity. This just means that they're going to be paying principal along with interest like a mortgage bond, which makes the bond less risky because you're getting some of the principal back along the life of the bond, not all at once at the end of the bond. Security interest, a provision in bonds that identifies any collateral pledged against the bond and how it is to be maintained. And the trustee, which is a separate individual that will act as a third party for the bond and act, can take specific actions on behalf of bondholders in terms when the bond specifics are violated. So the cost of bond to the issuer. In general, the longer the bond's maturity, the higher the interest rates, which we have talked about. In addition, the larger the size of the offering, the lower the cost in terms of percentage of the bond, because economies of scale. Also, the greater the default risk of the issuing firm, the higher the cost of the issue. We know that. And finally, the cost of money in the capital market is the basis from determining the bond's coupon interest rate. So we use the capital markets to help set the rates for these different corporate bonds. So a conversion feature allows bondholders to convert their bonds to stock, which is a neat feature. And a call feature is generally, which is included in nearly all corporate bond issue, gives the issuer the opportunity to repurchase the bonds at the stated call price prior to maturity. So the call price is the price which a bond may be repurchased, usually higher than the actual price of the par value. And the call premium is the amount at which the bond's call price exceeds a par value. So it's a little compensation in case they call the bond early. And calling the bond early is like the businesses refinancing their debt at a lower rate. So if they refinance the debt at a lower rate, you're out your bond that pays a higher rate. Okay, so let's talk about the call premium. So the call premium is equal to 1 year of coupon interest and compensates the holder in case it's called prior to its maturity. So issuers will exercise the call feature when interest rates fall, and the issuer can refund the issuer at a lower cost. So they have to fall enough to make up for the call premium they have to pay. So this is a little extra insurance for the bond holders, which makes the bonds less risky. So typically, issuers pay a higher rate of interest to investors for the call feature compared to issuers without the call feature. Bonds also are occasionally issued with stock purchase warrants, which are instruments that give the holders the right to purchase a certain amount of shares of stock at a specific price for a certain period of time. So it's a sweetener to help lower the cost of the bond, which means lower the interest rate paid to investors if they include this purchase warrant. Including warrants typically allows firms to raise debt capital at a lower cost than is possible in their absence. So it's just an added benefit. In a call warrant, a stock purchase warrant acts a lot like a call option. Okay, so the three most widely cited bond yields are current yield, yield to maturity, and yield to call. So when we talk about bond prices, because most corporate bonds are purchased and held by institutional investors such as banks, insurance companies, and mutual funds, rather than individual investors, bond trading and bond prices are not readily available to individuals like stocks. So stock prices you can find all over the web all the time, very easy to find, but bond prices not so much. But although most corporate bond prices issued with a par or face value of $1,000, all bonds are quoted as a percentage of par. So when you see a $1,000 par value bond quoted at 94, the price is at 94%, or so a $1,000 bond at a quote of 94 would mean the bond is trading at $940. And corporate bonds are quoted in dollars and cents, so the price of 103 for the day would mean that the bond, $1,031 bond, that is at 103.143%, and we multiply that by the bond value. So bonds are quoted differently than stocks. We quote them as a percentage of the par. Okay. So here's some data on select stocks for different companies, different coupon rates, different maturity rates, different prices, and different yields to maturity. Here are some of the Moody's and Standard & Poor's bond ratings. So these are two different agencies that look at bonds, value bonds, and give a rating on how safe the bonds are or what type of risk the bonds hold. Think of these ratings like grades for a class. The A grades are better quality than the D or C grades, and they have Standard & Poor's uses all capital letters, and the more A's you have, the better, just like a report card. So having one A in your report card is not as good as having 3 A's. And Moody's has large uppercase and lowercase combinations, and they can actually combined have a BAA class, which is very similar to a triple B class. And these are rating systems, and these rating systems were criticized highly during the Great Recession because they had such high ratings on subprime mortgage loans, but they were really, when they were rating them AA or A level, they were really C or D level. So can we really trust these bond ratings after we saw from the Great Recession is not 100%. So the idea is that the bond ratings would tell you how likely it is or just demonstrate the risk in the bond. But the subprime crisis has exposed some weaknesses in the rating agencies' ability to reflect the actual risks, and some of the ratings were influenced by business-related ties they had that complicated their process. So ethically, their bond ratings were influenced by things other than the straight-up risks of the bonds. So characteristics and priorities of lenders. So as far as the traditional types of bonds, we have the debentures, which are unsecured bonds that are, only the creditworthiness of the corporation are what is securing them. And we have subordinate debentures, where these claims are not satisfied until the more senior debentures are satisfied. And we have income bonds, which are payments of interest are required only when earnings are available. So commonly issued in recognition of the reorganization of a failing firm. So these are different types of bonds, unsecured bonds. Now, secured bonds, like mortgage bonds, are secured by the real estate. Collateral trust bonds are the value is generally secured by the stock owned by the bond's the corporate parent of the bond. And then equipment trust bonds are backed up by the equipment or inventory or physical assets the company owns. So if they don't pay the bond, you get their assets. Okay, so international bonds, there are also, besides companies, there are also other governments that can issue bonds and other foreign companies that can issue bonds to create an international bond market. So the Eurobond is a bond issued by an international borrower and sold to investors in countries with currencies other than the currency which the bond is denominated. So you could have a Eurobond for US dollars issued by Germany. In contrast, a foreign bond is a bond issued by a host country's financial market in the host country's currency by a foreign borrower. So a foreign bond could be a German company issuing a bond in euros. So both markets give borrowers opportunity to obtain large amounts of long-term financing quickly in the currency of their choice with flexible repayment terms. All right, so characteristics of contemporary types of bonds. We have the zero coupon bond, which is like a savings bond, which pays no interest, and so it's a $1,000 bond. You may only pay $600 for it, and then you receive $1,000 when it matures, but you don't receive any interest along the way. Hence the zero coupon bond. Junk bonds are issued for companies who have very high risks and have low ratings and are likely to default. Floating rate bonds are bonds issued where the interest rates can float along with the market forces. Extendable notes, these are shorter maturities, typically 1 to 5 years, that can be renewed for similar periods, options based on the holder. So they're similar to floating rate bonds that every so many years they get sort of restated and renewed at the more current interest rate. And puttable bonds, these are bonds that can be redeemed at par at the option of their holders, either specific dates or after dates of issue for every 1 to 5 years thereafter. They can put the bonds in, so it takes specific actions such as being acquired or acquiring another company or issuing a large amount of additional debt, which can trigger the put on the bond. It basically allows investors to get out of the bond. So valuation. So how do we value bonds? And so there's a valuation process, and the three key inputs for the valuation process are cash flows, timing, and the measurement of risk, which determines the required return. So let's skip the personal example. Here is the basic valuation model. So in this valuation model, we're using basics of time value money to discount the future cash flows to create a value of the bond at the end of those future cash flows. So we add up all the future cash flows discounted with the time value money plus the payout of the par value to calculate what the value of the bond is currently. So in bond fundamentals, as we noted earlier, bonds are long-term debt instruments used by businesses and governments to raise large sums of money, typically from diverse pool of lenders. And most bonds pay interest semi-annually, as stated in the coupon interest rate, and initially the maturity of a 10 years to 30-year time frame. But some bonds can be 100 years. Disney has issued 100-year bonds, but they're rare. And the par value typically is $1,000 that must be paid back at maturity. So we do have, a basic model for valuing bonds given this equation. So here's our basic bond value equation, where we're going to use Excel to value bonds, but this is the equation it's based on, looking at the annual interest rates, the number of years of maturity, the par value in dollars, and the required rate of returns on a bond. All right. So if we look at Mills Company, they have a large defense contractor. On January, they issued a 10% coupon interest rate 10-year bond and $1,000 par. Investors who buy this bond receive the right of the cash flows of $100 a year, which is 10% times 1,000, at the end of each year, and $1,000 returned to them at the end of the 10th year. So assuming that the interest on the Mills company bond is paid annually, so most of them are semi-annual. We're going to stay with annual here just to make it a little bit easier to calculate. The rate of return equal to the bond's coupon interest rate equals, so interest rate's $100, which is 10%. The par value is 1,000, and the N is 10 years. So if we discount each of the cash flows plus the return of the par value, we find that if we're doing this at 10%, this is the cash flows we're receiving in interest, the present value of the bond, so it's going to equal $1,000. So this is if the valuation and the interest rate are both equal at 10%. Now we could use this, we can use Excel to calculate a bond valuation in Excel. That is simply, we have these inputs, and then we can calculate the value of a bond in Excel. So here's an example of a bond valuation using the present value function. So what we have is an argument box here, and if we input the rate, which is the required rate of return is 10%, the N per, which is the number of years, the payment, which is the interest payment, and the future value, which is the par value. So you see these inputs here have labeled here as well. And the annual coupon rate is not going to be our rate. We have to use the required rate of return. So if the required rate of return, which we saw from the example before, if the required rate of return equals the coupon, the annual coupon rate, the par value of the bond is going to be the actual current bond valuation. But if we lower the required rate of return, the bond valuation increases as the rate of return required is lower, meaning that you're willing to pay more than $1,000 if your required rate of return is 7%, the bond coupon rate is 10%. If the required rate of return increases, we see the value of the bond decreases as the rate of return increases. So if you need 11% rate of return, the bond's only offering 10, you're going to pay less than the par value for that bond. So this is just something we want to detail. But to calculate bond value here, we want to use the present value function to easily calculate the bond value. Now, and that's what we basically have laid out here. So in practice, the value of the bond in the marketplace is rarely equal to the par value because of changing economic conditions, shifted the interest rates, and the change of such as inflation would be a main economic condition. Also, the rate of change of risk in the firm is going to be another factor in making that will be expressed in the difference between the par value and the market value of the bond. So, I mean, if we look at what if the required rate of return for the bond rose to 12% or fell to 8%? So we see here if the bond's required rate of return goes up, the bond value goes down, selling at a discount to make up for the fact it's only paying 10% and the required rate of return is 12%. If the bond's paying 10% and the required rate of return is 8%, the bond's more valuable and it'll sell at a premium. And these are what we had expressed in the spreadsheet before, that if the interest rates go down, bonds will sell at a premium. And if interest rates go up and the required rate of return goes up because the interest rates or the riskiness of the company goes up, the bond will devalue. And this is the bond value and required rates of return. So if the required rate of return is increasing, here we show increasing, the actual bond value decreases and sells at a discount. And this is what we call the inverse relationship between bond prices and bond values. So the interest rate risk is the chance that the interest rates will change, and thereby the required rate of return and the bond value would change. So rising interest rates will decrease the bond values, and lowering interest rates will increase the bond values. There's that inverse relationship. So we can see that here. Here's the time of maturity, maturing in 1 year versus maturing in 10 years. And here is the market value of the bond. So if interest rates move from what we have here is 12%, 10%, and then here we have 8%. So at zero maturity, they're all equal. But 3 years out, the bond valuation between the 8% bond and the 12% bond is $100. If we move to 10 years, the maturity is going to mature in 10 years, we see a much bigger, a much wider difference between the $1,000 par, the discount selling at a higher premium, and discount bond selling well below the premium, and a premium bond selling well above the par value. And this is what we see the time value maturity based on longer times of maturity having a more amplified effect in the value of the bond. So the yield to maturity, the YMT, is the rate of return that investors will earn if they buy a specific bond, at a specific price and hold it until maturity. So what happens if I buy a bond at a premium or a discount? That's the situation where we need to use yield to maturity to figure out the value of the bonds. So the yield to maturity on a bond is the current bond price equal to the par value of all the coupons equal to the coupon interest rate. So when the bond value differs from the par, the yield to maturity will differ in the coupon interest rate. So here's an example of here's the different cash flows that the bond can issue, and then how we calculate yield to maturity. So in Excel, basically, here's that same example. What we do here is we use the internal rate of return function. So we call up the function, internal rate of return, and we just highlight all the cash flows and hit enter, and we get the yield to maturity. So if I'm buying this bond at a premium here, and I'm receiving all of these interest rates and receiving the par value plus my last year's interest rate, my actual yield to maturity is 8.77% because I purchased the bond at a premium. Now, yield to maturity, we can also use the rate function to help calculate the yield to maturity. So this is done. So if we have the same information as up here, but it's expressed as the $1,000 bond, 10% coupon, where the current bond price is $10.80, we could use the rate function here, the rate function, and we can input the NPER, the payment, present value, which is the current bond price, and future value, which is the par value. If we make these entries in the rate function, we can also get the bond yield to maturity. So we could do the internal rate of return on the cash flows, or the rate function to calculate the rates based on the inputs of the bond. So the two ways to calculate the yield to maturity. So now the yield to maturity in semi-annual interest, because most bonds pay semi-annual interest. So the procedure to value bonds paying interest semi-annually is similar to what was shown in time value of money, compounding interest more frequently than annually. We have to, the thing here is that semi-annual interest has to be divided by 2, and the number of years to maturity has to be multiplied by 2, so we can convert that formula. This is the converted formula for doing a semi-annual interest, which most bonds are expressed as semi-annual interest. So here is that formula again with actual numbers put into it, but we're going to use Excel to calculate semi-annual interest. So if I pop back over to Excel, okay, so if we have semi-annual interest here, so the par value, the coupon rate, interest payments per year is 2 because semi means 2. So the annual interest payments are only 50 because you're getting payments twice a year. So that's the $100. The 10% times 1,000 is 100, but you get 50% payments, $50 payments twice a year. The annual the required rate of return is 12% annually, and the years to maturity is 10. So if we're going to calculate the present value, we have to factor in, when we calculate the present value, we're going to divide the rate by B78, which is 2, and we're going to multiply the years 10 by 2 just to signify there's 20 periods at an interest rate of 6%, required rate of return rate of 6% for 20 periods, and the payment and the future value are both going to be the same. So the payment is the 50 and as same as displayed here. So here we're just modifying the annual information into semi-annual information to be able to calculate the present value of the bond. And this is similar to what's shown here. So we're just taking into effect, just like we learned in the time value money chapter, that if it's semi-annually or quarterly or monthly, we have to adjust the way we calculate the bond to increase the number of periods and decrease the annual interest rate to the appropriate time frame. Okay, so that is the end of this chapter. Please also review my chapter. I have a separate lecture on spreadsheet help for the spreadsheet that I built to go along with this chapter to help reinforce the concepts of how to calculate the answers in the spreadsheet. And I hope you enjoyed this lecture, and I'll talk to you soon. Thank you.